Welcome back to accounting. First, I want to welcome you from a week off, an unscheduled week off. I hope you appreciated it. I was stuck up in the mountains during the snowstorm, and I was praying they were going to cancel this class because there was no way I could make it down for it. And luckily, in the end, they did cancel class for me. But what that means for our schedule is that we are basically just going to push back by a week what we're doing. So unfortunately, we will not be able to make up that class. It will mean we will end up doing less in the end. So as you know, on the website, I'm trying to keep track on the calendar of what we're doing and where we are and what's going on. So if you just follow the calendar on the website, and I will try to keep that updated so you know exactly where we are. Let's do a few more announcements, problems, issues while we're going here. Next thing is that the class next week, Monday next week is a holiday. However, what they have done at RPI is they then make Tuesday a Monday schedule for classes, which means we will be broadcasting this class Tuesday night next week. That's Tuesday the 20th of February instead of Monday. Monday's a holiday, but you guys don't get a break from me at all next week. I apologize for that. Next question that I got before class has to do with the projects, and somebody asked the problem sets, and someone asked, you know, what's going on with the problem sets? Where should we be? And the answer to that is, by the time we finish class today, you pretty much should be able to be working on everything from problem set number 1 and everything from problem set number 5. Problem set number 1 is the basic accounting material. Problem set number 5 is present values. We will be doing present values today in class. So, you know, you haven't seen present values yet. So chapter 5 will be based to a large extent on what we're doing today. Problem set number 2 starts out talking about inventory and issues like that, and we will not do inventory until next week at the earliest. So, you know, if you have worked through problem sets 1 and 5 by, say, next week, that would put you in pretty good shape in terms of where you should be for the classwork. Remember, we have the, through video streaming, we have me answering many of the problems from each of those 2 problem sets. And, you know, you may want to work through along with me the first time through, because some of the questions, the old test questions, are a little bit tricky. And if you haven't started working on them, now's a good time. I also have a question about the project. And the first question was, is the project still going to be due at the time that we originally said it was going to be due, given that we had a day off? And the answer right now is, I think we'll be okay. I mean, I'd allowed for a lot of slush in the amount of material, a lot of time, and you should be able to do the project when it's currently due, but we can update that as we get closer. If we don't cover enough material, I'll be happy to postpone it. That's you know, we'll make that decision at the time. What I thought I would do right now is give you a little bit of an idea of how to do this project. So if you haven't yet looked at the project, let me give you a little bit of background. And the background goes like this. I'm going to give you an income statement and a balance sheet. And I'm going to ask you to forecast for the next 5 years what the income statement and balance sheet would be. Now, I will then give you a large number of assumptions that you need to use. Many of the assumptions you can do on your own. But, you know, I'll give you the basic idea right now. As you can see, if you look at the bottom of the screen right now, there's a there is an evaluation process that we try to use. And there's some questions that I would greatly appreciate you taking a look at, just so I get feedback on how we're doing, how you're picking up what's going on in the class. And so the evaluation is on our website. If you just go to the website and click to where the evaluation icon is, you'll get beamed into basically just a questionnaire. And that's really important for me, because in the past what I have done is when people give me feedback, sometimes I've changed the course a little bit. I've tweaked it here and there to meet your needs. Sometimes people have specific needs. Some classes do. To which I would like to think I'm responsive, although sometimes I'm not. But in any case, this gives you an opportunity to give me a little bit of feedback on how I can do things a little bit better, how you're perceiving what we're doing, and how how I can just make your experience a little bit better. So if you would fill that out for us, please, I'd greatly appreciate it. Okay, the project. I'm going to take a very simple case and show you how to forecast 1 year. And what you're going to find is that the forecasting process is a very, very simple one. The details make it more complex, so I'm going to extract away from the details in this very simple example. I just want you to get the basic idea. Well, here we go. We'll start with an income statement and a balance sheet. The income statement, I'm going to have revenue less less expenses gives us net income. Nice double line. A very simple income statement. I'm going to have current. Let's go cash. Then I'm going to have other current assets, non-current assets, giving me total assets. On the liability side, I'm going to have current liabilities. I'm going to have long-term liabilities. I'm going to have common stock retained earnings. That's going to give me total liabilities and equity. Any questions before we go any further? Does this stuff look at least vaguely familiar? Now you've had a week off, and get those synapses firing a little bit here. Make up some very simple numbers. So this is our period zero amounts. In period zero, let's say revenue for the year is 400. Expenses were 300, therefore net income was how much? 100, thank you very much, right? Cash, and I'm making up numbers. Let's say we total it to 1,000, right? Just to pick a number. So let's say cash was 200, other current assets was 300, and therefore non-current assets was 500. That totals to 1,000. Now, current liabilities, once we know the total assets is equal to 1,000, what is total liabilities and equity going to have to be equal to? Same thing, right? The balance sheet has to balance, so for assets equal liabilities plus equity. So this is going to be $1,000. So I'm going to just distribute these things up. Let's say we have 100 as current liability, 200 as long-term liability, 300, got the pattern here, as common stock, and that leaves me 400 as retained earnings. Any questions about that?
What does LTL mean again?
Long-term liabilities. Any liability longer than 1 year in maturity. So this is what I'm going to give you in the project, kind of. Right? What I'm going to give you is a little more detailed, right? But this is the basic idea. Now your job, your mission is to then forecast periods number 1, 2, 3, 4, 5, 6, 3, 4, 5. 1, 2, 3, 4, 5. And what we're going to do right now is go through a process for how to do that and the heuristics behind what to do. Now let's make a few assumptions over here. Let's say that sales increased by about 25%. And we'll leave it at that. That's our only assumption going in. Right? Now, if sales go up by 25%, what happens to revenue? Revenue goes from what to what? What's 25% of 400? 100. So sales goes to what? 500. Any problem there? Again, very heuristic is how I'm doing this. And this is how you're going to be doing it as well. Right? So, I mean, you're going to need to be precise in some areas. You're going to need to make assumptions in other areas. So, I mean, what I'm doing is not unreasonable. Now, if sales went up by 25%, how are our expenses going to change? What's your best guess? A reasonable guess would be they're probably also going to go by about 25%. Now, you could make an argument that, well, we went into a cost-cutting mode, and even though sales went up by 25%, expenses only went up by 20%. Is that reasonable? And the answer is sure, right? That's reasonable. So let's make that assumption, right? It's not part of the assumption that was given to you. It's part of the assumption you would make. Now, 20% of 300 is how much? 360. So the next level of expenses would be how much? 360. Questions about that? That gives us net income of how much? 140. Any questions so far? Now, in the example, in the project you're going to be doing, you have to worry about a lot of different items. You have to worry about inventory. You have to worry about interest expense on debt. You have to worry about a lot of different items. But this is the basic process for how you would do it. Question?
So why did you pick 20% versus 25? You just randomly picked it again.
You didn't like 20%?
Well, I just don't know why you would.
You want 30%. Well, pick any number you would like. It doesn't matter, right? As long as you give me an assumption that defends why this company either increased their expenses for some reason or decreased their expenses, we're making guesses out into the future based on what we know about our company, right? And so my assumption is we have a very good company and we're going to become more efficient into the next year, right? And therefore our financial structure is going to reflect our increase of phenomenal managerial ability. Okay. Other questions? Well, once we know what net income is, we can go down and do retained earnings. What is retained earnings going to be, given that we know that net income for the year is 140?
540.
And the answer is, well, retained earnings is what? Retained earnings, quick reminder, is, right, it's an equity account, beginning balance plus net income, subtract out what? Dividends, gives you what? Ending balance. In this case, beginning balance is how much? 400. Net income is how much? 140. Dividends are how much? Well, simple example, let's assume they're 0, right? In this simple example. Therefore, the ending balance retained earnings is how much? 540. Does that make sense, everybody? So we plug in 540 over here. Any questions? Now, the method that I would suggest you use for forecasting the assets and the rest of the income statement is what's called the percent of sales method. And the basic idea is that if sales went up by 25%, that's going to be your basic guess about how everything else is going to change. Because what happens is, if sales went up by 20%, then probably we have more current liabilities because we're buying more things. So we could say that, well, maybe current liabilities go up by 25%. On the other hand, current liabilities are probably more closely related to our expenses, right? And if our expenses only went up by 20%, then maybe current liabilities only went up by 20%. Now, in the project that you are going to do, you get to decide how these things change. And all I ask is that you tell me a story justifying how things increased over time. But the basic idea is that if sales are going up, it's likely expenses are going to be going up. If sales are going up, it's likely you're going to need more assets to justify and support those sales. If sales are going up, you're going to need more liabilities to buy the assets to justify the sales. So everything's going to kind of progress at this percent of sales kind of notion. Does that make sense, everybody? Okay. So here, let's use 20% for current liabilities. So current liabilities go from 100 to how much? 120. Long-term liabilities. Now, long-term liabilities are things like a mortgage. And mortgages usually go down over time when you pay them off. Well, let's assume it goes down by $10, just to pick a number. So long-term liabilities goes from 200 down by $10 to how much? Let's say 190. Now, common stock, unless we sold more common stock, probably did what? Probably stayed the same. So that gives us 300. Now I do something which is the scariest thing on earth in front of a class. I'm going to add these things up, 3, 4. 0, 11, 15, 3, 6, and 5 is 11. Please tell me that's right. Okay. Now, if 1150 is the amount of total liabilities and equity, then we know what? Total assets have to be what? 1150. That makes sense, everybody? Again, the balance sheet must balance. Every year I make a bet with anyone in this classroom who wants to make the bet right now. I will bet you right now, I'll bet you anything you want, that of all the people who hand it in, one person hands in a balance sheet that doesn't balance. At least one person. And I will make this, offer this bet every class between now and when everything is due. Okay? Just trying to get you to understand. If the balance sheet doesn't balance, you made a giant mistake. You lost one letter grade on the project. Right? If it's off by $1, you lost one letter grade on the project. If it's off by 1 penny, you lost one letter grade on the project. Okay? If the balance sheet doesn't balance, then anyone who knows anything about accounting thinks your company doesn't know anything about anything. Because the balance sheet has to balance. Okay. So far our balance sheet balances. Now we have to go in and forecast our other things. Now, what I suggest is that, in the end, and here's the trick, right? In the end, you need some kind of a fudge factor. You need some kind of a number that's going to be a plug in the end to make the balance sheet balance. And the number I'm going to use to do that is the cash account. And we'll see why I do that in just a second. But in any case, now we're forecasting other current assets. So non-current assets, maybe we bought some more, maybe we didn't. Let's assume we didn't buy any new non-current assets. And usually what happens is we depreciate them over time, right? So let's say we depreciate them over, let's say 20 years. 10 years would be 50, 20 years would then be 25, right? So if we have depreciation expense, if current assets go down net by 25, the new balance would be how much? 475. Right? Everybody comfortable with that? Other current assets. If sales went up by 25%, other current assets probably did what? Probably went up by 20, 25%. The other current assets are what? Inventory. Why did it go up? Because we're selling more goods. We have to have more goods to sell more goods. Accounts receivable. As we're selling more goods, we're going to have more receivables. So other current assets are going to go up. So it goes up by 20, 25%. 20 is easier to multiply. Let's use 20%. 2 times 3 is 6, so it'll be 360. Okay, now I need someone to do some arithmetic for me. Given that I know total assets are 1150, and I've estimated non-current assets to be 475, I've estimated other current assets to be 360, how much is cash? 315. Oops, that's a 3. Doesn't look like a 3, but it's a 3. Any questions? So I've just forecasted 1 year. And now your job is to forecast years 2, 3, 4, and 5 as well. Question?
Why didn't net current assets go down again?
Other current assets didn't go down because what's included here are things like inventory.
Right.
As you're selling more goods, probably you're going to need more on hand to be able to meet the orders, right? So inventory is probably going to go up.
But the net goes down because...
No, the net goes up. Net other current assets increased, right? From 300 to 360.
Below that one down. Right.
Non-current assets are property, plant, and equipment, and we're depreciating that over time.
Oh, okay.
Right? And so that's why that would go down. And then we plug cash. Carson?
When you say to tell a story, do you mean that at each stage along...
What's your name? Delcy. Got an R in there. Sorry about that.
Yeah, that's okay. At each stage along the way, do you want us to explain sales are increasing 25%, and therefore I'm making the assumption that these other assets are increasing 25%?
20%, or again, whatever. It doesn't have to be by the same percent, right? And when you look at the project, you're going to find that I tell you how sales change, right? So you have to calculate based on what I told you what sales will be for the 5 years, and then based on that, then you start to estimate how to do the various expenses, and you would base your estimates either on what the sales were, or you could concoct some kind of a business plan and base your estimates on what's going on in your business plan, which I would think would be a very good thing to do, because that way you're thinking about how business relates to your financial statements. And I think that would be an even better scenario for you to be thinking about. Don't just ad hoc things. Think about things more strategically and make the financials agree with what strategically the company's trying to do. Question?
How many transactions you want us to do? Like, there could be several transactions, am I right? Account payables, receivables, stock, and inventory, selling inventory, buying inventory. Like, how many transactions?
Well, okay, you do not have to model all these transactions. You didn't see me do any entries, did you? You didn't see me do any T accounts. All you saw me do was forecast the financials, and that's all I'm asking you to do. Okay? So, when you're asking me how many transactions, the answer is, you don't need to create accounting entries in the sense of transactions. All you need to do is create financial statements that balance and that are coherent, right? Coherent in the sense that they have to be reasonable. For instance, some people handed in and said, well, even though sales are going up by 25%, I decided inventory was going to stay the same for 5 years. That's my assumption. And that's a bad one, right? Because there's not a firm in the world whose inventory stays the same for 5 years, no matter what happens. And so that would be an unreasonable assumption, and I'd give you a boot in the pants for that particular assumption, right? That would cost you half a grade or something along those lines. Just, again, so your assumptions have to be reasonable given whatever let's be very generous and say that's whatever your business model might be. Kelsey.
The deliverable here is a sheet that has 6 columns on it, essentially, and then the write-up that's attached to it that explains what the trends were over 5 years?
Yes. Yeah, well, it's a little more complicated than that, because you're going to need to hand in an analysis of how you evaluated inventory, so I can check that. You're going to need to hand in an analysis of how it's called amortizing the loan to calculate interest expense. You're going to need to hand in a calculation of what stock price will be based on your assumptions. You're going to need to hand in a few exhibits that you can do, and my suggestion is to do this all in Excel. And my further suggestion is just to email this to Stacy. So your job is simply going to be to email to Stacy an Excel file that includes the financial statements and any documentation that she might need in order to check your calculations. Did I answer that question?
Well, how creative do you want us to get in these things? Like, as far as, refinancing your mortgage, or, having inventory change and using leftover inventory from the previous year, and like.
I think that you should get creative, but not stupid, in the sense that the project here is to get you thinking about financial statements. And what some students do is they get all involved with doing fancy modeling and real fancy presentation on the Excel spreadsheet and things like that. And that's very time consuming. And there's lots to do in this class. Spending 35 hours doing funky stuff on this project probably is not the best learning experience. On the other hand, you want your assumptions and your financial scenario to be consistent with some kind of a reasonable strain of thought, and so they should line up. Does that make sense? All right, so there's a trade-off there. Have fun, be clever, but don't waste time. Is my suggestion. Any other questions?
Is the $20 prize for real?
$20 prize is for real. In fact, I will pay it on the air.
Okay.
I pull $20 out of my wallet every year. Someone gets $20. Now, the $20 is for the person who has the highest stock price. And we'll talk about stock price evaluation in a different. Again, we'll talk about this project every class as we go forward. And I'll save that harangue for a different class. Any questions? Okay. So much for the project. Needless to say, since you now know that I'm going to be talking about the project every class, it probably makes sense to start the project, right? And the project really is, I mean, learning how to use Excel, in my opinion, is probably one of the most important things that you'll get out of this class. And what I will do in class, although I'm not going to do anything tonight, is I will be using Excel and doing financial modeling for you. And, there's a lot of little tricks that you may or may not be interested in, but stuff that I think is worth knowing. And we'll be going through a lot of that kind of stuff in future classes. We now need to finish up Chapter 4. So in the notes, I'm going to finish Chapter 4. Then we will go on to Chapter 5, which is present values. If we have any time after that in today's class, we'll go on to Chapter 13, which is ratio analysis. So that's our progression for today's class. Chapter 4. Do a quick review of what's going on in Chapter 4. Here we go. Chapter 4 deals with the accounting cycle. And in the accounting cycle, we have transactions. And the transactions include what? Buying stuff, selling stuff, crap like that. At the end of the year, call this 12/31, we create what's called a trial balance. Now, a trial balance is what, again? What does a trial balance look like? If you look at Chapter 4, on page what? On page 3, that's a trial balance. A trial balance is what? Simply a list of all the debits and credits. And notice the debits are equal to the credits, right? So trial balance balances. That's a very good thing, right? Similar to the balance sheet balancing being a very good thing, at least as far as your grade is concerned on the project. Okay, so after we do the trial balance, next thing we do is do adjustments. And adjustments are for what? Why do we do adjustments? Well, do we make a mistake? Right? If we made a mistake, we adjust that. We try to find that right now. Primarily what we are doing with adjustments is we're doing accrual. We're trying to match expenses to the correct period and revenues to the right period. And by matching, we mean we're making accruals. So our adjustments are primarily accruals. We are recognizing the amount of interest expense, we're recognizing interest revenue, we're recognizing insurance expense, doing all the things that require an analysis as of the end of the year. After we finish doing our adjustments, we create an adjusted trial balance, which is where I think we ended class last time. And the adjusted trial balance appears on page 10. Now, the adjusted trial balance usually has more accounts on it than the trial balance. Why is that?
All the adjustments that we made.
Okay, well, what adjustments did we make that wouldn't necessarily appear in the trial balance? Depreciation expense probably wouldn't appear, because depreciation is not a transaction, right? Any kind of accruals for interest, either interest revenue or interest expense, insurance accruals, insurance expense may or may not be on the trial balance, but in any case, we'd expect there to be slightly more. Any accruals that cause us to recognize a liability would be a new account. For instance, wages payable, I think, was one of the accruals we made last time. Having finished the adjusted trial balance, the next thing we do is we do closing entries. Now, we did not talk about closing entries last time. What are closing entries? What are we closing? Doors? Windows? We are closing retained earnings accounts. That's exactly right. More specifically, what are the retained earnings type accounts? All of our revenue accounts, all of our expense accounts, and one other account. Dividends declared. So the three types of accounts that we are closing are all revenue accounts, all expense accounts, and dividends declared. That's a D. Man, I have miserable handwriting. So dividends declared. Why do we do that again?
You start the year fresh.
We start the year fresh is the right answer. Why do we want to start the year fresh? Because the income statement measures a flow across time. It measures from January 1st to December 31st. That's the annual income statement. Now, if we're measuring this flow and only this flow, that means that as of January 1st, all of our revenue accounts have to have a zero beginning balance, and all of our expense accounts have to have a zero beginning balance as well. And that's the only way we can measure the flow from January 1st till December 31st. So we close out all of those accounts, and we close them into an account called retained earnings. So we close them into retained earnings, and what that then tells you is retained earnings is the account that accumulates all prior earnings for the company from period one, right, from the very beginning. Now, after we do a closing, the entries, we do a post-closing trial balance, and the last thing we do is we create financial statements. In this case, an income statement and a balance sheet. Any questions? So what we need to do in class today, which we haven't yet talked about, is we can take a look at what this adjusted trial balance looks like, and then talk about the closing entries, and then take a look at the post-closing trial balance, and then look at our financial statements. Any questions? Okay, notes. I am on page 4-11. So on page 411, we first look at page 410, which is the adjusted trial balance. Keeping in mind, we are going to close out all of those income statement accounts and dividends declared. Now we go to the next page, and what I do in this particular closing process is I create a separate account called income summary, which is what's called a temporary account. So I will use T accounts to show what I'm doing. Here's our retained earnings account. Let's make a nice big retained earnings account right here. And the retained earnings account has some beginning balance, so it's an equity account. What was the beginning balance in retained earnings again? We go to the trial balance, or the adjusted trial balance. We look for retained earnings as of January 1st, $29,400. And that was our beginning balance. Right? Everyone with me? Now, the next thing we do is we close out our dividends declared. And that's entry C1 on page 11. Dividends declared during the year. Now, dividends declared, what type of an account? An equity account. Dividends declared has $2,000 in it for the trial balance. So in order to close that account out, what do we have to do? Well, we want to bring this T account down to a zero balance. We have to credit it for dividends declared. We credit dividends declared for $2,000. That's journal entry C-1. And if we credit dividends declared, we debit retained earnings. So we debit retained earnings for 2000, entry C-1. Questions about that? So entry C-1 in journal entry form in the notes is exactly the same as crediting the T account. Notice dividends declared goes to what? Goes to zero. So we closed out, we zeroed out dividends declared. And that caused a reduction in retained earnings. Now let's go back to, remember our analysis of retained earnings when we did the project? So I'm going back to the project that we just did. Remember what we said? Retained earnings. We have a beginning balance. We add in net income. We subtract out dividends. Gives us ending balance in retained earnings. That's what we're going to do right here, right? We have beginning balance in retained earnings. We're going to subtract out dividends. Right? We're subtracting them out. We're going to add in net income. And that's going to give us our ending balance in retained earnings. Right? Same thing we did. The same process you'll use on your project. Now, in order to close out the income statement accounts, I created a separate account called Income Summary. An income summary is a temporary account, but it would be considered an income statement type of account. Now, the first thing I did in the notes was I closed out all the revenue type accounts. So if you look at entry C-2, and I'll create that entry very quickly here. What I'm doing is I'm closing out sales, and sales account had $199,600. And I'm closing out other income accounts, commissions earned and interest earned. I'm also closing out estimated customer defaults or bad debt expense. And the net effect goes to income summary. And the net effect in this case is 203,650. So on my T account, which I'm about to transfer over, again, we have these various amounts here, another amount right here. The net amount that goes to income summary is 203,650. Again, that's entry C-2. So I bring us back to our income summary, and we are crediting 203,650. So I'm crediting income summary for 203,650. And the entry would then be to zero out all of the income statement accounts and then create this temporary account. This is entry C-2. Questions?
Why isn't estimated customer defaults an expense?
You could do it as an expense if you'd like. I just included it because it's related to revenues. However, everything would still balance if you included it with the expense. It doesn't matter at all. Judgment call, and either way is right. Questions? C-3. In C-3, we're zeroing out all the income statement expenses. And so we're listing wage expense. They're debits to begin with, so we credit wage expense. We credit all these other expenses for whatever they might be. And so we end up debiting income summary. And the total amount for which we debit income summary is $191,260. Okay, so does that make sense to everybody? All we're doing is zeroing out those accounts. They have debit balances in them. To zero them out, we are crediting it, and the balance of everything goes into an account called income summary.
That 191,260. That's the sum of
all the expenses. Yes. So we go to our income summary account, and we have a debit here of 191. What did I say that debit was? 260. That's entry C-3. Now the net here, so the thing you have to realize here, what's going on is on the right-hand side, these are all our revenues. On the left-hand side is all our expenses. And so our revenues less our expenses are going to give us what? Net income. So we net these things out, and we get the net income is $12,390. Does that make sense to everybody? However, since this is a temporary account, we then need to zero out our income summary account and put our net income into our retained earnings. So in order to zero out income summary, we're going to debit income summary for $12,390. That's entry C-4. And notice that brings this balance down to 0. And so the debit goes to income summary, the credit goes to retained earnings for $12,390. So now we can figure out our ending balance and retained earnings just like we did when we did the projected income statement earlier in class today, right? We have our beginning balance plus net income less dividends declared gives us our ending balance, and Lord knows what that is because I'm not even going to pretend to do that. $39,790. Questions about that? So again, the key thing here is to recognize that we are zeroing out. The closing process is very simple. All we're doing is we're zeroing out all of our income statement type accounts. Questions?
Why do you use the why do you create the income summary? Why don't you just go directly to retained earnings?
Okay, so the question is, why do we bother using an income summary type account? And the answer is, well, the reason I do it at this, now if this is for computer software, it would just go right to retained earnings, okay, in the closing. But the reason I do it in this context is I have an income summary account that gives me a check so that when I go and create our income statement, I can check to make sure that what I got there in my calculations is what I ended up on my actual income statement. And so what we're going to do next is we're going to go through and take a look at all of our balance sheet and income statement, take a look at the financial statements, and make sure they make sense to us, right? So all the work we've done, we want to make sure that our balance sheet balances and our income statement, in fact, make sense. And the way we can make sure our income statement makes sense is it has to agree with our income summary. So if we move to page 4-12, 4-12 is the post-closing trial balance, and notice there are far fewer accounts on our post-closing trial balance than there were on our adjusted trial balance. And the reason obviously is why? All the income statements went poof. Next we closed them all out. And again, notice the post-closing trial balance balances. While we're at it, let's go back to the project for a second. And on the project, do not put any pennies in. Anytime you forecast financial statements, you never use pennies. So basically, just make sure you round everything to the nearest dollar. All right? So in your projections, no pennies. Keep it simple. Keep everything to the nearest dollar. On page 13. 13 is our income statement. Notice we have sales less estimated customer defaults, gives us cost of goods sold, gives us net sales less cost of goods sold, blah, 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 going down. You all can make an income statement up now, so I'm not going to go through that with you. But notice the bottom line, right? And the bottom line is also known as net income. In this case, net income is how much? $12,390. Notice that net income agrees with our income summary amount that we worked through in class. That just gives us a little bit of confidence that we didn't transpose any numbers, we didn't make any mistakes in creating our financial statements, that net income, in fact, is a bona fide number. Below that, the reconciliation of retained earnings, we did that in class, but again, that's very important to make sure that retained earnings make sense. Next page, the balance sheet. On the balance sheet, again, what I will check every time, for every one of the projects that gets handed in, one of the first things I'm going to check is the balance sheet balance? Next thing I'm going to check is retained earnings correct? So I'm going to look at last year's beginning balance plus this year's net income, less any dividends you might have declared, and make sure retained earnings is correct. Notice here, the balance sheet I presented here is what's known as a classified balance sheet. Now, why is this called a classified balance sheet? And a classified balance sheet, we usually classify things. There's a total surprise to everybody in the room and everyone listening. But more specifically, we classify them into current assets and current liabilities and non-current assets or long-term assets and long-term liabilities. So a classified balance sheet gives you line items, one for current assets, which in this case totals $110,050, and then gives you non-current assets, which in this case is property, plant, and equipment for $24,000, en route to total assets. Similarly, you have total current assets, you have 0 long-term liabilities, and then capital stock retained earnings. So again, this is a classified balance sheet. Now, when you are talking about strategy, right? When you talk about a firm strategy, some firms are top-line oriented. What does that mean? The firms are top-line oriented. What are they trying to maximize?
Cash. Yeah.
Sales, right? Look at the income statement. What's on the top line? Sales. So when you talk to people who are talking strategy, you go, oh, they're top-line oriented. What are firms in today's economy that are top-line oriented?
Amazon.
Well, remember the old economy, new economy stuff that was going on a year ago? And how nobody had to look at profits anymore. All you look at was sales. Because the expectations, if the sales were there, profits would come sooner or later. And all those stock prices were going through the roof. Well, that was a top-line directed strategy. Firms trying to maximize sales in order to maximize value. And then all of a sudden the bottom fell out of the market. Why was that? Because all of a sudden we go back to basics, which is unless net income is there, the firm probably isn't going to be too valuable. So all of a sudden, evaluators went to a bottom line analysis, which is more akin to what's been going on since the history of time. Right? But anyway, I wanted you to have some sense of these kinds of terms, right? Because many of the terms come off simple accounting statements, like in this case, the income statement. Questions? All right. So much for Chapter 4. On to Chapter 5. Before we do that, any questions? Okay, Chapter 5. We're going to be talking about present values. Now, hopefully you all have present value tables. And I'll be using the present value tables in a future class. I'll be using the computer to do present values. But for today, I'm just going to get my calculator out. Help me do a little bit of analysis here. Quick show of hands. Who has never seen present values before? Does anybody have any idea what I'm talking about? Okay, so I have enough people here who have never seen present values before that I need to go through it in reasonable detail. So those of you who know present values back and forth, and some of you have had me in class, now would be a real good time to take a nap. Go get a drink, bring a beer back for me, maybe, you know. Make yourself useful. Introduce some terminology. And not only some terminology, but the basic process. Suppose, in the notes I'm on page 5-3, more or less. So you don't need to write all this crap down. So you know I'm going to be doing what's on page 5-3. Just watch what I'm doing for now. A firm starts out, or an individual starts out, has $1,000. How come my face looks green in that picture? I don't like that at all. I'm back. Firm starts out with $1,000, and the firm is able to earn a return. Now, in this example, we're going to use 10%. So 1 year later, if the firm can earn 10%, how much do we have? And the answer is, well, we have the original $1,000. In addition, we have interest on the original amount, which is 10% of 1,000, which is 100. So at the end of 1 year, we have how much? 1,100. That makes sense to everybody. And that is 1 year hence. Now, terminology. The amount in period 0, So we'll call this period 0, this being period 1, period 2 coming up over here. That's called the present value. Or simply PV. Now in economics, it's also known as the price. Because the price is the present value of future cash flows. So in economics, we use the term price. But in terms of our analysis here, we're going to be using the idea of present value or PV. Now, in this example, we are going from the value at period 0, and then we're calculating the value 1 year later. That's known as what? The future value. In this case, it's the future value in period 1. And the future value in period 1 is equal to what? Is equal to the present value, which is the $1,000, plus the interest rate, called out I, times the present value. Or it's equal to the present value times 1 plus the interest rate. Does that make sense to everybody? And in this case, obviously, that's equal to what? $1,100. No problem there. But this terminology stuff is important, right? And the terminology stuff is in period that, you know, present value is always period 0, and then we're moving forward by 1 period each time. Questions? Okay, period 2. In period 2, what do we have? So at the end of 2 periods, having invested $1,000 in period 0, what do we have at the end of period 2? Well, we have the original $1,000, the amount we originally invested, plus we have the $100 that we earned at the end of year 1. In addition, we earned 10% on the amount they originally invested. We had another $100. And here comes the magic. And the magic is what? That in the second period, we earn interest not only on the $1,000 that we started with, but we earn interest on the additional $100 that we earned in period 1. So 10% of $100 is how much? $10. So the magic here is that the interest that we earned in period 1 then earns interest in period 2. And that $10 right there is the key to understanding everything there is to know about present values and future values. So when we add all this crap up, we get 1, 2, 1, 0. Questions about that? Now, 1, 2, 1, 0 is also known as the what? Future value in period 2. Now, using our nomenclature we discovered right there, that's equal to what? It's equal to the present value times 1 plus the interest rate times 1 plus the interest rate yet again. Or it's equal to the present value times 1 plus the interest rate squared. Does that make sense to everybody? Now, when you're doing present values, you're going to have a number of different ways that you can calculate them. One way is to do what we just did, which is to go through using exponential notation and calculating them out using a scientific calculator, which is a very doable thing to do if you happen to have a scientific calculator. Now, another thing you can do is everyone in the class should have present value tables. So if you'll take out your present value tables, you should have 4 present value tables that you downloaded off of the web. And the 4 tables are just a big list of numbers, a big spreadsheet full of numbers. Now in this case, what we're looking for is the future value of a lump sum or the future value of a dollar table. So in this case, this is table right here. It says the future value of a dollar. Now if you would please zero in on this particular table for me. Hello? There we go. Notice on the table, if you go across the first row, we have interest rates. We go down the first column, we have number of periods. So in this particular case, it's a situation where we are in our second period, and we're going to go over to 10%. So the number I pick off the table is 1.210. Everyone, that makes sense to everybody? So, in terms of, made your life miserable back there, thank you very much. Well, getting my glasses out here. Okay, there we go. So, in this particular case, what we're looking for is the future value of $1,000 for 2 periods at 10%. And if we go to the table for 2 periods 10%, we got what? 1.210. That's the number we looked up, right? Multiply that times the $1,000, and we get 1210. And therefore, 1210 is the future value of $1,000 for 2 periods at 10%. And that's equal to the number we calculated right there. Questions about that?
Does the table take care if the interest rate changes from year to year?
No. In fact, if the interest rate changes from year to year, you need to model that in Excel or some similar type of program. Let's do another example. First of all, let's look at some of these numbers here. Do you think it's a random event that in period 2 we are squaring 1 plus the interest rate? Is that a random event, do you think? And the answer is, well, not exactly. Suppose we are in period 8. So the present value times 1 plus the interest rate to the 8th power will be equal to the future value in period 8. Does that make sense, everybody? Let's do that using the table. So in this case, the interest rate is 10%. Number of periods is 8. So this would be the future value of $1,000 for 8 periods at 10%. That's equal to some number. So it's going to be 1,000 times 8 periods at 10%. And I'll walk through this thing with you one more time. So we go across. Sorry about that, guys. Okay, so we're going down here to period 8. We're going across 8 until we get to 10%. I get 2.144. Does everybody agree with me? So 2.144. Sorry about that. So 8 periods, 10%, 2.144. That tells us that the future value is equal to what? 2,144. Does that make sense, everybody? How much interest have you earned over the life of this asset? How much interest have you earned over the life of this asset? Well, we started out with 1,000, right? Ended up with 2,144, and so the increase is 1,144. That would be the amount of interest revenue we would have earned over the life of owning that particular asset. Does that make sense, everybody? Okay. So that is future values. Let's talk about present values. Present values is something very similar. Present value is, suppose we have some amount out in the future. Let's say it's 10,000. Let's say it's 5 years hence. And now the question is not if we start out with a certain amount of money, what do we have at the end? But now the question is if we have a certain amount at the end, how much did we have to invest at period 0 in order to have 10,000 in the end? Again, let's assume we're earning an interest rate of 10%. Questions? Well, using scientific notation, how would we calculate this? What did we find out before? We found out that the present value times 1 plus the interest rate, in this case 10%, to the fifth power, because it's a 5-year time horizon, right, is equal to the future value in period 5. We plug some numbers in here. Well, let's not bother yet. So if now what we're looking for is the present value, we solve for the present value, we get what? That the present value is equal to the future value in period 5 divided by 1 plus the interest rate to the 5th power. Everybody with me? So in this case, plug some numbers in. The present value is equal to 10,000 divided by 1.1 to the 5th power. And if we had a calculator that did exponential notation, we would then get that number. Questions?
Where'd you get the 1.1?
Where do we get 1.1 from? 10%. 1 plus 10% is equal to 1.1. Questions about scientific notation? How would I do it if I were you? What I would do is I would look at, well, we're looking for the present value of $10,000 for 5 periods at 10%. In order to do that, we have to look at the present value table. So if we look at the present value table, and in notes, the present value table looks like so. And if you would zero in on this table for a second, please. Guys in the back hate when I do present values. Zero in, zero out. Zero in, zero out. Okay, so it's the present value of $1. That's the table we're talking about. In this case, we have 5 periods, so we go down to the 5th row. We go over to the 10% column. And I get right here 0.6209. So I come back over here. Back in for me, thank you very much. 5 periods, 10%, 0.6209. Multiply that times 10,000. And I get $6,209. Now what's that equal to here? It's equal to the present value of $10,000 earning a 10% return for 5 periods. Or more specifically, it's equal to the amount we have to invest today, earning a 10% return compounded annually over 5 years to then have $10,000 at the end of that period. Questions?
Will we have the tables on the exam?
You can bring tables to the exam. You can bring a calculator to the exam. You can use Excel. You can use a computer to do this as well. So anyway, that's comfortable. And I would recommend using Excel. Of all those methods, my recommended suggestion is to use Excel. Questions? Let's do another one. Suppose we have $100,000 at the end of, let's think about it this way. Let's say you have a son or a daughter who is currently 10 years old. And let's make them 8 years old. And they're going to go to school 10 years from now. They're going to go to college. And you figure it's going to cost you $100,000 to buy their books the first year. And so the question becomes, how much do you have to invest today to earn a 12% rate of return over 10 years? Does that make sense, everybody? So what we're looking for is, how much do we invest today, assuming we can earn a 12% rate of return over 10 periods, at 12% per period. And so here, the present value of $100,000 for 10 periods at 12% is equal to what? Now, my recommendation is, rather than using tables, you want to either use some kind of a handheld calculator, and I use an HP calculator, though it's no better or no worse than any other calculator that has present values, or to use Excel. Now, in this case, just to show you how simple this really is, I'm going to plug in 10, and up here is number of periods. Then I'm going to plug in 12, this button right here, that's an I for interest rate. I'm going to plug in 100,000. That is the future value right there. And then I'm going to hit present value. and it should give me the number, 32,197. So 32,197.32 is what I'm hoping the answer is. Now, someone please check that against tables to make sure that's right, just to make sure we're doing everything correctly here. So putting that into words, what does that say? That says if we invest 32,197 today, earn 12% for 10 periods, then we'll have $100,000 10 periods from now. Questions about that?
So, with that formula there, you're assuming that 100,000 is the present value, not the future value.
No.
Okay.
Anytime I'm doing this right here is what I'm looking for, right?
Okay.
So I'm looking for the present value of this amount. Looking for the present value of this amount here, which is $100,000.
Okay.
So 32,000, blah, 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 is the present value. $100,000 is the future value.
So then when we do the present value before the PD would change to an F, or?
Now, if I were looking for the future value,
Right.
this would be FV right
It
here.
would be FV. Okay.
Right. Questions? Now, Boylan's suggestion is anytime we're doing present values, the trickiest part is to understand the cash flow. Understand when the payments are happening. And so my suggestion is anytime we do a present value calculation, draw a picture. And just understand the basic information before you move on. Questions? Okay. Let's do what's called an annuity. What is an annuity? First question, what is it? What's an annuity? Dave, what's an annuity?
A series of payments over time?
Partially right. It is a series of payments. What's the key thing? The bill, right? Series of what?
Uniform payments?
Series of uniform payments. That's right. It's the same payment every period, right? So the key thing about an annuity is it's the same payment every period. It could be a payment that you're making, or it could be a payment that you are receiving. Either way. So it's the same payment every period, right? Now, let's do an example. Let's say that you are going to put some money away for college. Let's put it away for retirement. And so you're going to put away $2,000 for retirement. Listen, who's going to retire in this room? Pick something. Bill, you intend to retire?
10 years from now.
10 years from now. You don't look 50. How about 30 years from now? What's a closer approximation? 30 years?
Fine.
Fine.
Sure.
Fine, he said. Whatever. So, Bill's going to retire in 30 years. And he's going to save $2,000 each year for 30 years. Bill, what rate of return are you going to earn on your investment portfolio in your pension fund, retirement account?
I'd hope about 18%.
Ooh. 18%, huh?
That's what the S&P has returned for.
Not this year.
Not this year. Prior to this year. It's what
Okay. Since 1929, what's the average rate of return on a market on the S&P?
12%.
12, 13, maybe 14 before last year. So instead of going 18, let's be aggressive. Let's say 14%. Okay? Just because it's a little more realistic. So it's 14%. What's my question?
How much money will
Well, we have at the end.
How much money will he have when he retires? That's right. Now, one way to do this is to take the future value of each one of these payments out into the future. But another way is to take the future value of an annuity. So in this case, the future value of an annuity, the big A right there, and the annuity is how much? $2,000 for 30 periods at 14%. We're giving you 2 extra %. What table do we look for? What table do we look at for this? Look at the table. It says the future value of an annuity. So in this case, the future value of an annuity, and we're going to go down to 30 periods, down here at the bottom. We're going to go over to 14%, so we're coming down this column right here. Going down to 13, oh my gosh, I can't see squat here. 'Please, Lord, get me to a number. 3, 5, 6, 7, 8, 7. 3, 5, 6, 7, 8, 7. Okay. 3, 5, 6, 7, 8, 7. Multiply that times 2,000, and we get 712,000, something like that. You have a better number for me?
707,574.
707?
Yeah.
Okay. So, Bill, when you retire, you're going to have 707,574.
Okay.
Is that enough?
I hope so. Well, hopefully there'll be other investments also.
Well, suppose, Bill, that instead of earning 14%, let's say you can earn 28%. Let's say you invest with someone that does an unbelievable job. So instead of earning 14%, you earn 28%. Now, if we double the amount of his return, are we then going to double his amount at the end?
No.
And the answer is no, why not?
Because you have to take into effect the compounding.
Okay, the compounding makes this an exponential function, to use engineering and mathematical terms, right? So if we go from 14 to 28%, we'd expect the future value to be much, much higher. About how much? What's your guess, Bill? I'm never going to volunteer again, he says. Oh my gosh, I hate this class.
Maybe about 4 times higher?
Give me a guess. 4 times would be 14, 28, 2.8 million?
Sure.
Okay. Anyone else want to take a guess before I do it? Is that for me? If that's for me, I'm not here. Okay. Someone's phone is ringing. Okay, so if we go, the number from the table, 28%. What am I getting here? I'm getting 5873. 5873 times 2,000. What's that equal to? 11.7 million. Right? So you double the interest rate and the amount goes up by about 13 or 14 times. In this particular example. That's no rule of thumb, that's just in this particular example. And again, the key thing to understand is what? The way this stuff works is, if this is time, let's see. How does this go? The exponential function looks like this. So this is total dollars, and this is time. What's going to happen is you're going to get incredible amounts of growth in the last few periods, right? The growth is going to be huge. Does that make sense, everybody? Because the base increases every year. And so this exponential notion is what makes present value so important. Let's go back to this example. Did I randomly choose $2,000 as our number for Bill's retirement? What do you think, Bill? Did I randomly choose $2,000?
No.
Bill's exactly right. Why not? What's the magic about 2,000, Delsey?
That's what you can put in an IRA.
That's what you can put in an IRA. Now, there's 2 types of IRAs. What are those 2 types? There's a regular IRA and something called a Roth IRA. Now, which one do you want to use, Bill?
Roth.
You want to use a Roth IRA. Bill's exactly right. Why? What's the beauty of a Roth IRA?
Isn't it tax sheltered until you want to withdraw it?
Tax shelter.
The whole life?
No. Close.
Pay your taxes up front. You get to keep everything at the end.
Any money you put into a Roth IRA is tax-free. Forever. Right? So any money you put in, that $2,000, it accumulates wealth over time, and in the end, that either $11 million or $707,000, whatever interest rate you were returning, it's tax-free. And this is called what? A Roth IRA. Now, how does that differ from a regular IRA? So,
haven't they upped the annual contribution to $5,000?
No. Hopefully they will.
Okay.
One of Bush's ideas, one of the things that we hired this guy to do, was in fact to help us to get a higher amount that we can put away every year in our Roth IRA, right? So one of the things that Bush hopefully promised, but you know how these guys lie, right? Is that we will be able to increase the amount that we put away in our Roth and our regular IRA. Now, again, the distinction between a Roth IRA and a regular IRA is what?
Where you pay your income tax.
Right.
With a regular IRA, you get a tax deduction for the amount you put into the IRA in period 0, or in every year. But then a regular IRA is called tax deferred. And tax deferred means what? That you earn a return over its life, but when you pull the money out of the IRA fund, then you have to pay taxes on the amount there. And my analysis suggests that a Roth IRA is 99.99% of the time a far better vehicle for most people to invest in than a regular IRA.
For regular IRA, they just take out, you just pay taxes on exactly what you withdraw from it, right?
That's
not like
correct.
once you turn 65, you get hit up for the lump sum.
No, you pay tax on whatever you pull out of that particular investment vehicle. So the moral of the story is to start a Roth IRA. And the moral of the story is start it today because why? You want to start reaping that exponential growth tax-free. Now, in my opinion, is this tax-free vehicle going to be around forever? And the answer is, I don't think so. Right? I think next time we get a Democratic president, we are going to have someone going, wow, we need more taxes so we can spend more money. And one of the things they're going to try to do is they're going to try to change the retirement stuff. So it wouldn't surprise me if this tax-free Roth IRA at some point in our future disappeared. So the moral to the story, and what I tell every one of my clients who can possibly do this, is start a Roth IRA today. Get as much money in it today as you possibly can. Now, here's one of the great things. If you start your Roth IRA today, which is February 2001, you can put $2,000 in for the year 2000. So you can still fund the year 2000 Roth IRA even though we are currently sitting in year 2001. So what my recommendation for you to do, if you can possibly do this, is to put $4,000 in as soon as you can, which would be the year 2000 contribution plus the year 2001 contribution, and start investing in those pesky tech stocks that by the time you are retiring are going to be worth a ton of money, even though they're worth the square root of squat right now. So, questions about that? Okay. Next, we talked about an annuity where we talked about the future value of an annuity. Now let's talk about the present value of an annuity. So, suppose you're thinking about buying a machine, and that machine will generate $10,000 in cash every year for 6 years. This is period 1 through period 6. Now, given that this machine will generate $10,000 in cash in period 1 through period 6, and given that you require a 12% rate of return, what is the maximum amount you'd be willing to pay for that machine today and still earn a 12% rate of return? So the question is what? The question is, what is the maximum amount you'd be willing to pay for that machine today, given that your firm requires a 12% rate of return? Does that make sense to everybody? In order to find that out, what do? Well, we take the present value of an annuity, and the annuity is $10,000 for 6 periods at our required rate of return, which is 12%. And when we do that, I'm going to do it, I'll do it here. So on this particular calculator, $10,000 is the payment. 6 is the number of periods. 12 is the interest rate. And I'm looking for the present value, PV. $41,114. And 7 cents. So the maximum amount you'd be willing to pay for that machine that earns $10,000 each year for 6 years would be $41,114. Does that make sense, everybody? Or in other words, that's some economics there, right? In other words, the present value of this annuity of $10,000 each year for 6 years at a 12% rate of return is equal to $41,114. Questions about that? Okay, let's take a break. And when we come back, more fun and games with present values. See you in a little while.